When we think of algorithmic trading, we usually imagine a blur of glowing server racks making millions of rapid-fire decisions per second. But early trading AI actually lived inside a highly rigid framework called a discrete action space. To the machine, the market was a world of absolute binaries. You were either a 1 or a 0. Because a binary system has no room for a middle value, the machine treats the instruction to buy as a total commitment. It pours every available dollar into the trade because its logic cannot process the concept of a partial investment, leaving it 100% exposed to whatever happens next. That all-in velocity works when the market is predictable, but in a chaotic financial system, that level of absolute certainty is a fatal vulnerability. Real markets are defined by sudden, unpredictable crashes and the systemic panic that follows. This chart captures the reality of the March 16, 2020 market crash. In a downturn this violent, a binary bot hits a mechanical wall. It lacks the programming to recognize a bad environment and simply step away. Because the bot is fully committed, it absorbs the absolute maximum impact of this selling pressure. It has no financial cushion because its binary brain told it there was no reason to keep one. Developers realized that to survive, they didn't need a faster AI. They had to teach a machine the human concept of caution. The major breakthrough came when deep reinforcement learning moved away from binary toggles towards continuous action spaces. The standard for this fluid logic is an algorithm called TD3, or Twin Delayed Deep Deterministic Policy Gradient. TD3 doesn't just pick a direction, it calculates a magnitude. It looks at the market and decides exactly what percentage of its capital to deploy, down to the decimal point. Unlike old bots that could only pull the trigger, TD3 controls the intensity of the risk. By giving the AI a volume dial for its capital, the machine stops reacting with simple reflexes and starts scaling its exposure based on the volatility it detects. When researchers tested this TD3 logic against years of volatile real-world stock data, they expected a more nuanced version of the same aggressive trading. Instead, the AI developed a completely emergent behavior. It started leaving massive portions of its capital completely uninvested. No one told the machine to hold cash. Through billions of simulations, the math simply proved that doing nothing was frequently more profitable than being in the market. Human traders often struggle with this. We equate doing nothing with missing an opportunity. But the machine's simulations arrived at a clear conclusion. Long-term survival depends as much on the capital kept off the table as the capital put in play. That uninvested cash isn't idle. It's a mathematically calculated shock absorber. The AI judges itself using the Sharpe Ratio, a metric measuring return earned for every unit of volatility endured. TD3 excels here. A cash buffer minimizes downside during sudden drops, keeping the portfolio stable while fully exposed models are wiped out. The AI is simply following the logic of that ratio. That performance is defined by maximizing the return earned for every unit of risk accepted. The world's most advanced quantitative AIs aren't winning because they're faster or more aggressive than humans. They are winning because they have mathematically validated the human wisdom of restraint. The ultimate hedge against an unpredictable world is the capital you choose not to risk. Despite making millions of calculations per second, the smartest move an artificial intelligence can make is to simply do nothing at all.